and ask yourself a year from now, what do you wish you would have done today? The punchline for all of you is that I think all of you will have wished a year from now that you owned more bonds today. Bonds are back. Companies were facing significantly tighter labor markets, but importantly, they were able to pass on their higher costs. So this was something we had not seen in several decades. We basically spent fiscally government spending like the most we've spent as a percent of GDP since World War II. It shouldn't surprise us that inflation was very high because basically the government was handing out all this money. We're likely going to have roughly only 3% growth in the US economy, but yet short-term interest rates are basically at 5% and potentially headed even a little higher than that. So typically when this happens, the economy slows pretty sharply. And so I don't think this is any unique period in history. In the United States, investors can earn 5 to 6% in bonds. We're also excited about the prospect for capital appreciation, price appreciation on bonds as interest rates likely go down over time. The good news is that we see growth slowing, and we actually think inflation has already peaked. So if you look at the US, UK, Europe, inflation actually has peaked about 3 to 6 months ago. So we are likely going to see this inflation come down. So if you go back to the prior administration in the United States, we had very tight borders. In other words, we were under-immigrating, and in fact, we've under-immigrated versus long-term trend, about 2 to 3 million workers. Well, guess what? Then COVID hit. So not only did we not have enough workers prior to COVID through immigration policy, but then COVID actually did lock the borders down. And by the way, this happened all over the world. So if you look at many businesses, particularly in the service sector, they were not getting those workers into their country. So this did create a temporary problem where basically on the supply side, many businesses could not get labor. And so this did create temporary inflation. But what we're seeing now on the labor market side is that is improving. And also the supply constraints on the product side are also improving. So to summarize, inflation should come down.
When investing in the credit market, what are the factors you must look into before you make the investment decision?
Sure.
Yeah.
So really the most important thing is three things: fundamentals, technicals, and then valuations.
Okay.
Those are your three most important. And fundamentally, what's really important now is what does growth look like? Because again, the link between nominal growth and profits.
Yes.
Also, you can have different economies and different business cycles. Technically, it's very interesting because technicals are simply supply and demand for bonds. So we saw a lot of issuance right after COVID because the central banks brought rates down towards zero, and bond yields came down with those short-term rates. The demand is much higher because you have, for example, in the US market, large insurance companies and pension funds that actually need that income to support their demographics and retirement. Once the central bank starts to lower rates, it will also create opportunity for foreign investors to buy even more US bonds because the hedging costs will come down quite a bit. And very simply, we have not seen this in 13 years.
What's really the difference between investing in equity and credit?
Yeah, sure. So equity is going to be much more focused on growth. Right now, inflation is an issue, and that inflation has caused central banks to have to raise these rates to such a high level. It's made bonds very attractive, but the problem is it's going to cause a growth slowdown. And typically when growth is slowing, you actually want to move out of equities into bonds. So in general, when growth is slowing, that's not necessarily the best time to buy equities. Today, again, bond yields at 5% and higher, you really do want to own more bonds.
This year, your projection is that the growth in the United States in terms of its nominal growth will be about 3%.
We think real growth will be roughly flat. Bernanke, who, as you mentioned, is the chairman of our global advisory board, and Rich Clarida, who was the former vice chairman, both of them believe, and I agree with them, that they feel that we'll probably get core inflation back down to around that 3% level by the end of the year. When you look through history, it's very rare that the central bank can take policy rates higher than nominal growth. They're not only able to lock in those attractive yields today, but 1-2 years from now, those rates probably would be lower, and therefore there's the prospect for capital appreciation, which means you could conceivably even get high single-digit returns in a high-quality bond fund today over the next 1 to 2 years. And so, again, this mid to high single digits is a long-term equity return, and yet the volatility is roughly 1/3. So we think today is a very good time to buy more bonds and to own less equities.
And then why is it that PIMCO has a special advantage in doing this active investment? Yeah.
If you owned an ETF, you would have had durations roughly at your benchmark, and you would have faced negative returns as those rates went up.
Yeah.
But PIMCO, as an active manager, did see that. We did position lower duration, lower interest rate risk than the ETF. And the other thing is that as the credit markets turn, those ETFs are basically forced to buy what's in their benchmark, whereas what PIMCO can do is we can buy what we call rising stars. A rising star is a company that's currently lower rated, but again, if you look out 1, 2, 3 years from now, there's significant potential for credit improvement. So we're capturing that, what we call structural alpha, by owning bonds that the ETFs can't actually own, that PIMCO can own, that hopefully over time can add value.
How long do you think the new normal will be and new neutral will be? Yes.
So the new neutral is simply that it's very likely that over the long run, inflation will be roughly at 2%. In fact, if you look at long-term history in the United States, it's been around 2%. Central banks do have the ability to get inflation back down to targets. And granted, this has been a very unusual period, but if you look at the inflation break-evens, the market is telling you the Fed and central banks have that credibility. In other words, they will ultimately be successful. It's just taken time. You know, my message today is you want to own more high-quality bonds. It's a very attractive time. Bonds are back.